Hello, my name is Dr. Renée Friedman, and I'm Global Head of Research here at EXANTE. And today I'm in conversation with Andrew Kenningham, Chief Europe Economist at Capital Economics. Andrew, thank you for joining me today.
It's a pleasure.
It's been quite a week in terms of news flow. And of course, the biggest thing in the news has been Donald Trump and Greenland. And I wanted to ask you a little bit of what your thoughts were on that in terms of the possible Greenland framework, what it may mean for US-European relations moving forward, and what wider effect it may have on particularly trade relations. We've seen that the European Union has backed off for now on retaliatory measures.
Yeah, I mean, it's certainly been an extraordinary week, no question. And it is, I think, alarming at European policymakers and plenty of people in the private sector as to how completely unpredictable, almost unstable US policy has been. And yeah, it's totally unprecedented to see this threat to take a large chunk of land from an ally as has happened. So yeah, it's really most peculiar. Of course, we are getting used to very peculiar things from Donald Trump. So to that extent, it's not as surprising as it would have appeared 10 years ago. In terms of what it means, I mean, it is quite hard is sort of to determine whether how substantial is going to be the long-term damage to the transatlantic alliance from the way that President Trump is behaving. And I think the Europeans, generally speaking, been pretty cautious in their response. They've got a lot of criticism from some quarters for being too soft and sort of bending over and sort of pleasing President Trump. But you can see why they do that. I mean, they're naturally hoping that you can kind of sit this one out and that President Trump will be succeeded by somebody who's more predictable and a better ally, if I can put it that way. And the last thing you want to do is to provoke even more sort of aggressive action from the US by, for example, by retaliating quite firmly and quickly. So I think that at the end of the day, the policy from Europe has been quite consistent since the beginning of last year, and certainly since the Liberation Day tariffs were announced. And that is to talk quite tough, but actually to do very little. So they have to say they're going to retaliate for domestic political purposes, and they have to be carrying the possibility of some retaliation in order to strengthen their position for any kind of negotiation that happens. But at the end of the day, they're really reluctant to do anything. They didn't retaliate all of last year. And this year, even if the US had gone through with the threatened tariffs of 10% and then 25%, my guess is that the European response would have been at the softer end. There were various options that were discussed, but the most aggressive response would have been this so-called bazooka, the anti-coercion instrument, which would have potentially allowed them to restrict FDI investment into Europe from America, or to tax digital companies and so on. But I really don't think they would have done that. It would have been too risky. They would have preferred to just wait things out.
Okay, given all of that, not necessarily the strength of their policy, but they're being a bit soft on that. Does this event actually bring to light the potentially growing underlying tensions that may already exist within the EU, particularly around trade, around debt, around monetary currency management? Essentially, we're seeing greater fragmentation risks of coming to the surface. And do you see that potential political instability intensifying through 2026?
So there's always been tension within the European Union, and there always will be. If you've got an alliance of many countries and decision-making which is quite dispersed, then you're going to get different points of view. And that's played out in public when there are negotiations or debates like this over how to respond. Sure, there were significant differences in the language used by, say, President Macron, who was sort of gung-ho to try and strike back against the US, and Friedrich Merz at the other side, who was much more reluctant. But I have to say, I don't think the differences of opinion were any greater than they have been on many previous occasions. I do think that had the tariffs been implemented, Europe would have agreed and they'd have coalesced on some sort of, as I say, probably at the softer end of the range of options that they had. In terms of wider fragmentation in the European Union and the Eurozone, Actually, look at the measures of spreads on peripheral bonds, or maybe even peripheral is not the right term anymore, but the countries with the higher yields, they're not particularly high by historical standards. There's no sense at the moment of the currency union fragmenting. And if you look at other measures of financial markets, so things like the VIX, sort of fear index, or you look at the equity risk premium, those sorts of things, they're not demonstrating very high levels of anxiety by historical standards, despite these historically unprecedented and weird things going on in terms of US policy towards its NATO allies. So I actually don't think things are that bad. I mean, I think the criticism of Europe would be slightly different, I would have, which is not that they're fighting, but that they're not putting forward a positive agenda. So what it would be nice to see, or many people would want to see, is much stronger commitment to joint borrowing and to a really serious step up of their defense capability. But on that front, I think, despite all the talk, they're also going to be changing things very slowly.
What does this mean in terms of the medium-term impact that it may have on the currencies, whether it be the pound, the euro, or other European currencies?
Yeah, so, I mean, we did see some movement in the currencies this week during the Greenland episode with the euro appreciating. I describe that as being a little bit of a sort of sell America trade, sort of a light version of it. So if you remember last year when the big tariffs were announced, the dollar really traded off. But it was on nothing like the same scale. And I think that's because people were not as worried about the economic outlook and the sort of macroeconomic model in the US. I mean, this time last year, there was a fear, or a little bit later in the year, there's a fear of the wheels coming off the entire debt management system and in the US, and fears of a recession there. That's not been the case here. So nonetheless, there's been a little bit of anxiety, so the euro strengthened a bit. But I think it's much more likely over time that exchange rates are determined more by the interest rate differentials, which typically are the most important driver of exchange rate movements, unless there's some exogenous event that comes along. And so, for what it's worth, our view at Capital Economics is that the ECB is likely to end up cutting interest rates later this year. And we think the Fed will also cut, but a bit less than the market's pricing in at the moment. So the interest rate moves, according to our forecast, would tend to favour a slightly stronger dollar and a weaker euro. So we have the euro ending the year at 110.
Okay, that's quite a drop down. I mean, we're hearing a lot actually from others that they're actually expecting the ECB to potentially have to raise rates towards the end of this year because of the increased fiscal expenditures feeding through to higher inflation. Those tariff effects that we're worried about haven't really come through, but doesn't mean things won't change. But the most important thing being that that debt levels are increasing, both within France, within Italy, and that could be problematic, and therefore also having an inflationary effect, and the ECB having to take action.
Our view is that there is going to be a fiscal stimulus in Germany. There has not yet been one, by the way. One of the things to note is that last year the deficit in Germany was smaller than it was the year before. So despite all the talk about fiscal stimulus and the fact that they removed or lifted the debt brake to give themselves room to borrow more, they didn't actually do it last year. I think they will do it this year, and it will help the German economy. And Germany is returning to growth, albeit relatively weak growth, after 5 or 6 years of really complete stagnation. So there will be some growth in Germany, but I think the fiscal stimulus will be a bit underwhelming. Germany has a very long tradition of spending much less than they say they're going to do. And a lot of the expenditure is also in areas which are not necessarily going to bring much of a bang for their buck in terms of the sort of multiplier effects, if you like. For example, quite a lot of defense spending will be on imports. Quite a lot of the infrastructure spending is on repairing existing infrastructure. It's not building out new infrastructure. So there are sort of range of ways in which it's a good thing they remove the debt brake. It prevents them having to squeeze demand by tightening policy, which they'd previously have had to. But there's no way that Germany's heading into some kind of major sort of Keynesian boom that would potentially cause inflation to take off. And
what about other European countries? It's becoming a bit fiscally looser.
So, and other countries on the whole are intending to tighten policy a bit. So, France probably will pass its budget eventually using this Article 49.3, which allows them to avoid a vote in Parliament. But they'll get it through, but it'll bring the deficit down a little bit from 5.5% to 5%. So it's still too high. France, we're quite worried about France. We're quite worried about its debt sustainability in the longer run. But it's not loosening policy this year. And then Italy will...
But given the increased level of tax, a corporation tax, from my understanding, or the extension of the corporate tax, will that not affect growth?
Yeah, I mean, there are definitely... I'm not saying that the things are looking good in France. They're not looking great. But you were talking about the inflation risks. And, you would potentially have inflation risk if there was a really strong increase in demand from fiscal stimulus in Europe. In Europe, but the stimulus in Germany is going to be a bit underwhelming in our view, whereas in France they're going to be tightening, which will tend to kind of dampen demand. Yeah, you're right; it will not help growth that you're putting more of the burden on companies again by extending this tax on the larger companies. And Italy's going to be tightening as well. So if you look at Eurozone overall, fiscal policy is fairly neutral. There might be a very small loosening. And it's the overall aggregate fiscal position for the whole region, which is important from the point of view of inflation in the Eurozone, which is what the ECB is targeting. So, short answer is we don't think there's going to be much of an inflationary boost. And in fact, on the contrary, there's quite a lot of things that are going to cause inflation to come down a bit. So we're getting inflation numbers next week, at the end of next week, from Germany and Spain. I think they will, most likely the headline rates will come down in both of those countries. And more generally, the sort of inflationary pressures in the Eurozone are fading, because wage growth is coming down. There was this big sort of surge in wage inflation following the energy price shock and price levels. It's taken quite a long time for wages to catch up, because a lot of these countries typically have sort of 2-year wage deals and that sort of thing. So it's quite a slow process. It's still working its way out. But if you look at measures of forward-looking wage agreements that have already been met in Germany, they're showing a distinct downward trend. So we think that is going to gradually pull core inflation down below the 2% target. Remember, inflation's already at 2% in Germany.
Yeah, it is. Okay, thinking about this in the growth dynamics, how do you see these factors affecting European stock markets? Where do you see, for example, the potential outperformers in the markets based on where we're seeing fiscal expenditures, or where that policy, the ECB policy, will hit most?
Yeah, I mean, we're not big on sort of stock picking, I should say. At our firm, we sort of focus very much on the macro outlook. But based on purely the macro, I mean, it's pretty clear that there should continue to be strong tailwinds behind the defense and the aerospace sectors. I mean, valuations have gone up a lot there because you've also got the dynamic of there being relatively little to invest in. But I think we'll still see a lot of positive momentum around defense and aerospace. And then the other sector that's done very well recently is financials, where, again, I think there's the prospects are still pretty good. We've got sort of net interest margins have improved now that bond yields have risen. And remember, although the ECB's cut interest rates from 4% down to 2%, the 10-year bond yields have not come down nearly as much. So there's still, it's helpful for the banking sector in terms of their overall interest earnings. There are plenty of problems in the European banking system, and it's does lack dynamism. We'd love to see more M&A activity, some more sort of genuine steps towards banking union. But if you just look at the financials, both the capital ratios, the liquidity ratios, and then their earnings potential, I think that the outlook is still pretty good in the short term.
Okay. Just want to kick on to that point that you mentioned on bonds. How do you see duration risk evolving through 2026? Particularly if inflation proves a little stickier than expected. For example, energy pricing is potentially becoming an issue again, particularly on the gas side within Europe.
Yeah, I mean, so our forecast is that inflation will come down, interest rates will come down. We also think gas price will come down as increased gas supply comes online from the US and from Qatar. But obviously that might be wrong, and you're quite right. Recently gas prices have been rising. So, European natural gas, the TTF rate's about 40 euros per megawatt hour last time I checked. So it's certainly risen. And if that turns out to cause inflation to rise a bit, longer duration bonds would then become, under a bit more pressure. There are a number of other dynamics that's going on as well. I mean, at the very long end, there's still this question about demand for ultra long bonds, which has been in structural decline because pension funds no longer need to lock in the same returns because they're shifting, from defined benefit to more defined contribution schemes. And we're seeing declines in demand also from insurance companies. So I think there is an issue there. The long end has, in the past, been kind of held, it's been anchored at quite a low level because of the structural strong demand. But without that demand, investors are not really being paid for the volatility that you get because of the long duration in these bonds that historically been paid enough. So I think that the ultra long end may well remain volatile. On average yields will remain a bit higher than they were in the past.
We have seen the yield steepening happening since last year. So we're expecting to see that. But what about, one of the things, as I mentioned, is periphery has done those periphery bonds have actually done quite well. We've seen a contraction of spreads happening. Do you see, and therefore, a potential for a potential sell-off in those areas that aren't doing quite well, so UK, Italy, even French debt?
Yeah, so, I think, we've got to I'm guilty of it all the time, but the term periphery is possibly no longer the best way to look at it, core periphery. The two Eurozone economies we're most worried about are Italy and France. And actually right now we're more worried about France than Italy. And we've been saying for a long time, we think the French bond yields will be higher than Italian ones for the next few years, probably. They're just, I think, slightly higher at the moment. But that's because in Italy, the debt stock is very high, but it looks like it will be fairly stable because the government is being quite cautious in its fiscal policy. Giorgia Meloni has a clear majority, and she has evidently decided to prioritize stability over anything else. So it's a potential risk for the future, but as long as she continues to have strong control over government policy, I think that things won't get worse there. There's more likely to be a flare-up in France, and that does seem likely to happen at some point. It seems the French political system will only deliver a proper fiscal adjustment when it's forced to do so, and so some kind of reckoning with the bond market is more likely than not in the next few years. But when exactly that will happen, I think is very hard to predict. It may depend a lot on the next presidential elections and on how if the Rassemblement National wins, how exactly they proceed, because we're not really sure, and I don't think are sure, what they're going to do with fiscal policy. The previous promises have been of big fiscal loosening. Now they're rowing back from that a lot. And see Bardella sort of trying to kind of talk a lot to the corporate sector and reassure them, but we're not really sure how that will play out. So there are big risks in France in our view.
One of the questions I then have is, what about European productivity? Because productivity levels, the structural factors still remain within Europe. Productivity rates haven't really kept pace with the US, for example.
No. Yeah, the backdrop for Europe is of an economy which is stable, but if you the big picture globally is that all the innovation and investment is taking place in the US, particularly in sort of very narrowly in the tech sector, and of course in China. In comparison, Europe is much less innovative, much lower levels of investment, much lower productivity growth, and on top of that, you've got the demographic situation which is declining, and you've got they're struggling in terms of competitiveness internationally. So Europe's share of global exports has been declining for years. China's has been rising. That is only going to continue in the coming 5-10 years, and Europe is probably going to defend itself with more trade defense measures. Tariffs like the ones on electric vehicles is probably going to be a lot more of that. But they are, outside a few pockets of innovation, maybe certain sectors, pharmaceuticals, some digital innovation, it's going to be an economy where productivity growth is quite slow. And we'll also continue to see manufacturing decline as a share of the economy.
Thinking of the trade situation, circling back to that, Europe, the EU has just signed an agreement with the Mercosur states. Yeah. How effective do you think that will be in terms of lifting growth or potential growth for Europe?
Yeah, no, I mean, it will have zero effect. I mean, even the EU itself, I mean, I forget the exact number, but they've said something like 0.05% of GDP over 10, 15 years. I mean, it is totally trivial. The purpose of that trade agreement is really political statement as much as anything. And it's also, of course, unclear whether it will ever get ratified because there's now been a lot of opposition. The Supreme Court is going to now decide on whether the member states will have the final say. If they do, then it will probably not get ratified. So it's kind of hanging in the balance. But yes, it's neither here nor there in terms of growth. And the same will be true of other trade agreements which are under discussion. I mean, the EU-Europe, India trade agreement may be a bit more important, but we're still talking really quite trivial numbers in terms of the overall impact on the economy.
And what about Europe's relationship with China? Because that has changed quite substantially.
Yeah, I mean, that's right. So, the way I characterize it is the good news is that other than the United States, most other countries, including Europe, including China, have avoided a lurch into really massive levels of protectionism. There has not been a global trade war. There's been a US shift towards quite high tariff levels. Europe and China, I think, are both keen to keep the overall tariff levels quite low because they both feel they benefit from continued reasonably open trade. China. Okay, so China, the good news is that they're going to avoid a sort of big lurch towards protectionism, but there is clearly increased tension between Europe and China over a number of areas. And the way that Europe responds is they use trade defense measures, which is things like anti-dumping duties, when they can make the argument that China is unfairly subsidizing exports into Europe. But it's usually driven by old-fashioned concerns about survival of domestic European producers. And there's a lot of lobbying from the relevant industries behind it. So we'll see that with the auto sector. I think there'll be more tariffs there because they've only put tariffs on certain kinds of electric vehicles, and the level of imports from China still hasn't actually fallen back. I think we'll see it rise again. They'll probably put more tariffs in place. And then we'll also see it with sort of often quite obscure commodity groups in certain chemicals and machinery and so on, where there are domestic producers in Europe who they want to deal with. But, I think it will be targeted and sort of gradual in terms of those issues. There are a bunch of other issues which we could talk about as well. There's critical minerals, semiconductors, and, there are plenty of things they can be fighting over.
Absolutely. Do you see Europe pulling back further from their green transition spending? Again, that is something that could potentially be inflationary.
Well, the green policies they often do tend to cause inflation. So if they're putting, carbon taxes on, for example, or regulations that require more sort of greener technology, which tends to be more expensive. So if they're rolling back from some of that might cause inflation to be a little bit weaker rather than stronger. But yeah, I think, all of the pressures are in one direction now, which is to water down the commitments on the green transition. And we've already seen that happen with the deadline for ending the sale of internal combustion engines. Won't be surprised if that's pushed back further. So yeah, for Germany in particular, I think the issue with vehicle production is about managing decline. And in another country, there could be a much bigger wave of creative destruction, and we could see a lot of factory closures and a lot more job losses. And then maybe they would get to a better place more quickly. But in Germany, it's still very corporatist. There's a lot of involvement of state governments and of trade unions. And the whole process is about managing, keeping people in jobs and so on. So I think, and they'll use loosening back, rowing back on green technologies will be part of it. Protectionist trade policy will be part of it. There'll be a bunch of other things that will allow that process to be less painful, but it would, at the cost of economic efficiency.
And also, I think it is the case in Germany and maybe for a few other EU member states, we are seeing a rising welfare bill, particularly via pensions.
Yes, absolutely. And one of the things that's not been commented on a great deal is that towards the end of last year, the coalition government in Germany agreed that they would use some of the headroom created by lifting the debt brake to row back on previous commitments to reduce pension entitlements. So it's to do with the way that they're indexed and so on. There were policy changes that were made many years ago to save money on pensions that they've now reversed. And we're seeing across Europe sort of efforts to roll back previous pension reforms. And of course, that's not the most productive way for government to spend money.
So obviously we'll be seeing, again, even though you're sort of getting rid of the super long debts, still we'll be seeing a potentially increased debt issuance from governments to cover this in future years.
Yeah, I mean, the pension costs are one of the fiscal pressures. There are a bunch of pressures, including rising health costs, higher interest rates, declining, demographics working against the fiscal side. So you've got higher dependency rates. So yeah, pensions certainly part of it. It tends to go slowly though. Pension changes take time, as people retire. So you can, it's not the sort of area where you see this sudden increase in the deficit that could cause financial markets to freak out. But I do think it's a cost. It's a very major cost for a lot of European countries, which they're all very dependent on public sector pensions. People rely on them. For many people, they're not very high, so it's pretty difficult for governments to cut those entitlements. You can change the retirement age, but that's highly controversial and only sort of saves you money in the long term. So often governments aren't particularly incentivized to do it because it doesn't help them in the period that they're in office. So yeah, the pension thing is definitely an issue.
So essentially what you've said is that the whole Greenland situation will one way or another blow over.
Probably. I think that's the most likely, yeah.
That there will not be a longer term impact necessarily on the US-European relationship.
Well, on that, if I can clarify on that, I mean, I think, Europe is in the US bloc. We kind of think of the world as being fracturing into two very broad blocks, a US bloc and a China bloc. Europe has no option but to be in the US bloc. It's highly, highly dependent on the US, as we all know, for defense, for intelligence, for its entire tech sector, many, many financial companies here, et cetera, et cetera. It's just not feasible for the Europe to leave that bloc in any reasonable time frame. What has happened is there's a lot more tension. They're still married, but the marriage is not as happy as it used to be.
That's a great analogy. And so therefore trade, we're not seeing any major changes. Mercosur are not actually being that effective. Issues with China will remain. Productivity will continue to be a big issue for Europe in terms of its competitiveness, even if we do see, as you expect, a degree of devaluation by the end of 2026. That pensions in particular are putting a weight on fiscal policies as well as debt levels moving forward.
Correct. Good summary, Renée.
Okay, great. Well, thank you very much for your thoughts on this. We look forward to finding out what will actually be happening. We never know what's going on behind the scenes a bit with these negotiations in terms of the framework. And as you said, we never know what will come out of President Trump next. So
no, that's for sure. Yeah.
Markets could be upset with that. But thank you again for your time.
Thank you. Pleasure.